Happy greetings, everyone, and happy Easter holiday greetings here from MIG Bank in Switzerland. This is Ron Williams, technical strategist within the research team, and you are tuning in one more time to my traditional monthly webinar here with FX Street. And today we'll be covering the Japanese yen major cycle reversal. Today is the 11th of April. And one of the things that I always like to start with is just contact details for any of you that want to ask questions afterwards in case we run out of time, or if you just want to stay in touch and just share any ideas over the next few weeks and months. My email address is r.william@migbank.com, r.william@migbank.com. I'll say it one more time, r.william@migbank.com, and I should get back to you as soon as possible. Also, MIG Bank have various social media forums, Facebook, you can catch MIG Bank there, but then also I have my own private corporate accounts on Twitter, rwilliam77, and on LinkedIn, Ron Williams. If you just type in my name, you can feel free to reach out to me. Also, I have been writing a few blogs on the fxstreet.net forum. It's been a while since I've actually put a blog there, I'll say that honestly, but I'm hoping to get back on the forum and answer some of your feedbacks and, of course, share some trading ideas out there. Okay, so moving on from there, just a quick overview. To some of you that might be new to my webinars, I've been in the business for almost 15 years now, or even more than that, unofficially. And during that time, I've spent quite an amount of experience and hard learning curve testing out various strategies. And one of the most important strategies to me all these years has been one thing and one thing only, and that is market timing. Timing in life and in markets is everything. And so that's something that is very important to me and important to my strategies and whenever I look at the market. Now, when I say market timing, I break it down into just these three areas, but of course there's a lot more groundwork that I spend to actually reach a high probability trade strategy. But the three areas that I'm just going to kind of share with you here, which I've shared in previous webinars: market cycles, so looking at time cycles, being able to look out into the history and maybe not predict the future, but at least decide what is likely to happen based upon certain patterns or certain events that have happened in the past. But also, when we look at cycles, it's important to look at correlations in the market and how various markets react with each other. For example, US dollar and gold. Traditionally, US dollar, if it rises, gold tends to depreciate, and vice versa. Japanese candlesticks trade setups are very important to me in terms of understanding the economic, so I should say the financial health of the market, not on a month-to-month basis, but actually intraday, day-to-day, or week-to-week basis. So you can get a very good idea of the emotional health of the financial market by looking at psychological patterns, but also the majority of candlestick patterns are reversal patterns. And so for me, that's very important because in a volatile market environment, guess what? You get a lot of price swings, a lot of turning points, and those turning points, you can gain an edge in predicting or at least anticipating and managing the risk when you're aware of candle patterns. Of course, you need to see candle patterns in a successful strategy. Last but not least, I look at a lot of indicators and also my own proprietary indicators. But one of the most important indicator suite of strategies that I look at is our indicators developed by Tom DeMark, a very well-known investor and trader who developed his indicators over the last 40 years. And his indicators are very much known as market timing indicators, counter-trend signals that basically let you know when there might be momentum exhaustion in the market or potential turning points. So you can see here how a lot of my areas that I focus on do focus on market timing. There's a lot more involved with it, but these are just three areas which I like to share with people. Okay, quick disclaimer. No information here constitutes a solicitation to buy or sell. It is only educational and informational purposes only, and so please keep that in mind whenever I'm talking about the markets or making any suggestions as to in which direction they may move. This is going to be a light follow-up presentation on the Japanese yen. You remember early last year I gave a webinar in November, late last year, early November, predicting a major 40-year long-term cycle reversal in the Japanese yen. So the positive news is we've had a big move already, 10% rise in just 7 weeks on dollar yen, and it has been a broad Japanese yen weakness that has taken hold last month. So this is a follow-up to that, but keeping in mind the recent increase in volatility, I've rechanged the part 1 section of this webinar to include latest market prices. I want to ask a quick kind of sentiment question as to how do you all feel, and remind you from previous presentations what my macro cycle view is in terms of the second quarter of this year. And to be honest, I really thought it would be very important to include this because it's just important that I tell the message once, twice, and 3 times. And also, I just want to make sure that it's clear to each of you as this breakout volatility begins in the market. Part 2 and Part 3 will focus only on Japanese yen. We'll talk about the major cycle awakening, and Part 3 will be talking about the flight to safety, what that means for the Japanese yen. Traditionally, a flight to safety or safe haven trading tends to mean Japanese yen rising in value. My question here is, to what extent will that happen this time around? Okay, so let's start. Quick sentiment question. All of you have seen the massive move in the markets over the last few days, over the holiday weekend. And basically, as we entered into the second quarter of 2012, we are starting to see either some signs of profit taking or deleveraging across a lot of those overcrowded risk trades, which we've all been aware of, and also my fellow peers in the industry that gave webinars just before me had mentioned. So my question to everyone here, are you bullish into not into 2012, but are you bullish still based upon what you've seen over the last few days and what you expect, or are you bearish? Yes and no. Bullish or bearish after what you've seen over the last few days? Are you still a big believer in the bull market, which has been very positive in the equity markets, especially of the US? Or are you a little bit cautious, a little bit risk averse? So we're getting some very bearish, someone's bearish on euro, bullish with the help of QE3. So we've got quite a few bears here, which is interesting. Gam saying bearish depending on how quickly Spain unravels, otherwise neutral. Bullish US, bearish midterm. So bullish, bearish, I mean, I should really be specific. Are we bullish in what time frame? Short term, medium term, long term? And are we bullish or bearish in different regions of the world, US, Europe, Asia, or various markets, FX, stock market, commodities, fixed income, and so on? But I mean, the biggest trade this year and last year has been markets which have characteristically shown high risk appetite, and so this popular binary trade, risk on, risk off, has been the soundbite that we've been hearing every single day on the mainstream media. So when we talk about multi-asset classes, it is pretty much driven by this risk on, risk off theme, and most people are actually accepting the fact that we might be just started a risk off period. Okay, just a quick question I'd like to ask before I move on is, how many people here in the webinar is it your first time to be attending this webinar? If you could just tell me first time and which country you're from. I usually ask this question at the beginning. I'd like to know my audience, so please, if you could all contribute and let me know, Are you first time or are you avid, committed attendees? And which country are you from? First time from Canada. First time from Canada. Welcome from Canada. Anyone else? First time from USA. First time from UK. Wow, we have a few new people here. A fan from Portugal. Hola in Portugal. Regular from UK. Almost a regular. You'll become a regular soon, I hope. Second time from Japan, Germany and regular. Second time from Philippines, regular from the UK. Fantastic. And I'll let that. First time from Hong Kong. Second time from Switzerland. Regular from Australia. Wow, we have all time zones here. Returning customer from Canada, committed from Japan. Big honor for me to be sharing this forum with you. Really welcome you to my webinars. I'm really trying to brand them as a highly kind of interesting and valuable forum for sharing ideas. And I hope that you can ask questions throughout the session and stay tuned. I hope you can attend each of my webinars. I'll just make a quick shout to someone from Africa, or regular person from Africa, and New Brunswick. So hello everyone, and one last point I'll make about the richness of attendees from across the world is this is very much a great example of capital flows moving around the world. I will talk to you about my outlook on the market each webinar, but the great thing is, all of you are here from across the world, and so moves in the market mean different things to each of you because of where you are in the world. And so just keep in mind that money acts exactly the same way. Money has no borders. Money has no affiliation to anything. It is attracted to where it can yield the most growth. And so interesting thing to keep in mind when we kind of start this risk-off period, where will the money move to? Okay. So I've long said, and if those of you who attend my early webinar this year, I did make the record, the view on the record that 2012 was going to be a bit like a football match. One quarter and the second half were going to be positive periods of time during this year. Now, most people were positive for the whole of the year because quantitative easing or popular trends were just extending even higher, especially the U.S. stock market. Government support, especially with the presidential election in the U.S., meant a lot of money was going to be pumped into the market. So a lot of people were really positive for various economic and also technical reasons. My point at the very start of the year is you really need to start looking at the market in terms of time fractals. So if you're positive or bearish, fine, but what time frame are you bullish and bearish in? And the other thing is cycles. I really commend to you in looking at the markets in a cyclical way because it really helps you understand how the market rises and falls and ebbs and flows in different cycles. And so my point here for 2012 was that the second quarter of this year was going to be a considerably volatile part of the year where we would see big drawdowns from some of the overcrowded risk trades in the market. And this would be healthy, maybe 10% pullback on some of the U.S. equity stock markets. It would be a healthy move in the market, but also a seasonal increase in volatility. During this time of the year, markets get volatile. That's how we get this turn of phrase, set in May and go away. And it's one thing to keep in mind. So the macro cycle that I kind of spelled out for the Western market is basically that this multi-cyclical diagram I'm showing you here, long-term, medium-term, and short-term cycles all overlaid. And basically, I said that we are roughly here, Western markets. So we've already peaked at the long-term end of things. So think about the multi-year cycle. And basically, the 2007 financial crisis was at the top. 2009 was at the bottom of that medium-term cycle. So that's when we start to see recovery into 2011, first half. And 2012 Q1 was pretty much an extension of what we saw in 2011. So if you had been trading the markets in the latter months of the previous year, you were just carrying on with your traditional strategies. Problem is, Q2 is likely to be where we are now. And so you can see Q2 there are highlighting a big drawdown on both the short-term, medium-term, and long-term cycle. And so that basically means that markets move very fast, very quickly. So in terms of price and time magnitude, we're going to see big moves happening very quickly. And this is what happens when you get all cycles confluence or interconnect at the same period. It means that there's a big move that can take place in a short space of time. So keep in mind that's the kind of roadmap that I use, theoretical roadmap for the Western economies and obviously the financial market. And that is potentially what we're going to see in the second quarter of this year. I went on the record on CNBC media to actually make this statement a week ago. Tomorrow morning you can see me on Bloomberg Europe early in the morning, I think around 8 in the morning, and I'll be sharing a similar view as to what I'm discussing with you now. So just keep in mind, second quarter this year, the one that we've just started, spring and summer months, is likely to see increased volatility. Just a quick hello to Fernando, a very committed client of ours in South America, Brazil. Thank you very much for attending, and I hope you enjoy the session. The Bloomberg interview, I think, is 7 o'clock GMT, London time. So you'd need to set your time accordingly. If you do want a web link to the recording of my media interview tomorrow or previous ones, please just send me an email. I'm more than happy to send it to you. Okay, so big question here is volatility. And I've been saying for some time, volatility has been low, and it's been irrationally low. And this is a chart of the VIX, the popular US measure of volatility based on the S&P index. And we are currently seeing volatility rising from historic lows. We're punching into the 20 zone, which is, still it's a comfort area, historically speaking, but keep in mind one important headline. Volatility based on the VIX has been the lowest ever since 2007 pre-financial crisis. So for some reason, the volatility indices out there are signaling that things have not been, are as good as they have been since the, just before the financial crisis. Now, my question to you is, do you believe that? With the amount of black swan tail risk out there in the market, how safe do you feel? Do you sleep well at night when you put on a trade the day before? Or are you concerned about some of the headlines that come out? Now, if you're bullish or bearish, you have to keep in mind that since 2007, there's been a lot more risk, a lot more volatility. And that's just not a kind of a sexy kind of thing to say or a buzzword that people are saying. It is reality. And so the reality that I want to illustrate to you here is if you do look at the VIX chart, look at the yellow areas that I've highlighted on the chart. Since 2007, we have increased volatility. And you can see there the spikes, the first one, second, third, and fourth. This is the new normal that people are talking about. This is the new, high volatility environment that we're currently trading in. And the most important thing here is, you are going to get periods of low volatility where you get beautiful trade setups, but most of the time you should be risk averse. You should be averse to risk. You should be waiting for that big breakout to happen in the market, or on the opposite side, that painful false signal to knock you out of a trade, even though you thought it was a great trade to take on. So these are tougher times to be trading, and so be aware of risks, but be aware of the event shocks that may take place. And so at the moment, volatility is rising from historic lows last seen in early 2007 before the financial crisis, and seasonally speaking, the spring and summer months of each year generally have high volatility. So seasonally, spring and summer of each year is a high volatility period in the market. And it's that turn of phrase I began with, sell in May and go away. This year it's likely to be sell in April and go away. So that signal is likely to appear slightly earlier. Now, what has happened in the market? Very simple. I'm going to choose the US S&P 500 proxy, and we've had a beautiful breakout from this multi-month pattern. That was also triggered by the market exhaustion signal. Remember I told you some of my key market timing indicators are based on Tom DeMark's signals. We had multiple exhaustion signals, but we had a grand finale one that appeared just days before the breakout. And I went on the record some time ago saying that we are likely to get a 10% drawdown, minimum drawdown on the S&P and various U.S. stock market indices. And 10%, by the way, from the breakout would have been the move into the long-term moving average. You see that red line there is the 200-day moving average, roughly at 1270. So the S&P 500 is likely to target 1270. We're probably going to get some kind of consolidation over the next few days as kind of people kind of work out their risk profiles and their positions. But just keep in mind that eventually we are likely to see further mean reversion into that level at 1270. Now, keep in mind this is all about risk reward. The U.S. stock markets have risen so much and they've performed so well, and people have made so much money. But as you continue to move up that profit curve, you are multiplying your risk. And so just purely from that risk reward basis, the markets, a lot of people kind of felt that maybe first quarter of this year they made some good profits. They didn't want those profits to be exposed, and so they wanted to kind of take that money off the table and lock it in for themselves, for their clients. So keep in mind that just purely from a risk reward perspective, a lot of people that have been long in the market, especially in the US stock market, just made the healthy decision to take some of that profit off the table. And that's a good thing. So this could just be a healthy pullback. I think it would be more than that. But just keep in mind either healthy pullback or potential dramatic setback to come. One other point I'll make is the markets have been very optimistic. And so if you look at the far left side of the chart, there it says the Greek deal. This is an example I like to use as to how extreme periods of optimism can sometimes trigger market tops or lead to market tops. And so an example is the Greek deal. So here we can see here back in July of last year, when there was a kind of a big euphoria in an optimism after a Greek deal was struck, one of the major Greek deals was struck, just days afterwards we had an 18% setback in 2 weeks. 18% setback in 2 weeks. So keep in mind markets can move in a big way very quickly, and July last year the market moved 18% in just 2 weeks, days after a Greek deal was struck. So optimism and euphoria amongst investors marked the peak in the stock market, and that led to a big fall very quickly. Now, the big headline that I think all of you should be really kind of keeping in mind is the NASDAQ technology sector in the U.S. is likely to activate a sharp setback more than any other index in the U.S. and potentially in the West. And that is because it has done something very historic. It has retraced half of what it lost since the technology crash. The NASDAQ has retraced half of what it lost since the technology crash in 2000, since the dot-com bubble. And that level is roughly around 3120 on the NASDAQ composite, I believe. And you can also look at the NASDAQ 100 to get an equivalent number. But basically that level has produced a major resistance barrier, psychological level, which also coincided with another market exhaustion signal and produced a very good kind of selling opportunity in the market. So just keep in mind that for structural reasons, the market, specifically the NASDAQ technology sector, is already due setbacks on the downside. Interesting that Facebook is about to undergo a historic IPO of about $100 billion at this moment in time over the next short-term period. So I always like to look at the kind of socioeconomic events and how that impacts financial markets. It's very interesting from a contrarian point of view that we have one of the most historic IPOs from Facebook coming out in the short term, and it'll be interesting to see how that affects Facebook, and if the Facebook IPO actually acts as a historic contrarian signal on the technology sector. I'm bullish on technology over the long term, but short, medium term, I'm thinking that we're going to get some significant downside risk. Now, one of the number one technology stocks and one of the number one market capitalized stocks in the world is Apple. How many people here love Apple? Can I get a quick yes and no? How many people here love Apple? They love the brand. They love the stock. They may have bought it. A few people say yes. I definitely hate Apple. One person saying hate it. Anyone? Any lovers? Unconditionally lover? No, yes. So we have a kind of mixed crowd here. Someone saying love Mac. I've had a lot of kind of very heated response from clients and various people I know in the market that are just die-hard Apple lovers. And don't get me wrong, from a brand perspective, I have a lot of Apple merchandise. The new iPad just came out and it's brilliant. But from a stock perspective, I'm a little bit concerned. And so some people, including myself, are calling this the irrational period on Apple. And no, it's not a new device that they've developed. It's just a play with words. And keep in mind that, if you have been invested in Apple, you've made a lot of money and you will continue to make a lot of money, and that's great. But since the beginning of this year to date, Apple has appreciated about 55%, which is great. It's the extent that it's moved away from its long-term moving average is huge. That's the 200 moving average that you can see on the chart. And at this moment in time, I'm expecting mean reversion risk following a market exhaustion signal which appeared several days ago into the 200 moving average. That would be roughly a 30 or so percent move, which would happen over time. It wouldn't be it wouldn't happen as quick as we might think it would. But just keep in mind there's a big mean reversion risk on Apple, and this would just be a healthy pullback. The trend would be very bullish, and maybe things could continue to be positive for Apple. But just keep in mind that at this moment in time, from a price perspective, it is very overbought. DeMark proprietary indicators signaled very recently that there's momentum exhaustion in the market, and just from a pure kind of moving average perspective, this is the most overextended Apple has been. And so you would at least want to use trailing stops or look for kind of key level confirmations on the downside for a potential mean reversion back into the long-term moving average, which is trading at 428. So significantly far from where we are at the moment. Now that's the technical perspective. Now that's from a bottom-up perspective. So that's from the stock level. But I was talking just a moment ago from the macro level, the NASDAQ. Now keep in mind that the NASDAQ technology sector is suggesting that we get a big drawdown on the downside. The Apple stock, which is one of the biggest stocks in the technology sector in the US and generally in the stock market, is also suggesting potential mean reversion risk. So from a top-down and bottom-up perspective, we are getting a confluence of signals suggesting a turn down over the next few days and weeks. The other point I'll make is Apple is not just a stock. It's not just a fantastic company. It's a multi-trillion-dollar market company. And so by itself, it acts as an economic bellwether, economic indication for the U.S. market, and also for anyone out there, big institutions and funds and whatnot that are invested in Apple. If you look at the figures, the amount of money which is actually invested in Apple is huge. So if we do get a 10% or more setback in Apple, that spells a big downside scenario for the stock market, and that's basically what I'm saying. Okay, now one other point I'm going to say is moving away from the US, Europe is going to be an interesting region to keep in mind over the next few weeks and months. In this relative world where we have this forest fire of tail risk, keep in mind that Greece has been the focus point from this kind of European contagion, turmoil with all the debt crisis that's been going on. But Spain is likely to see a rotation of risk from Greece back to Spain. So I really want you to kind of focus on that. We're likely to see a lot of big negative surprise from Spain. Spain is likely to feel a little bit of pain over the next few weeks, and this is what the market is telling us. If you look at the stock market, and if you look at the credit default swaps, which are rising versus its peers in Portugal and Italy, Spain is looking like it might feel some pain over the next few weeks. And of course, this would be bearish for the euro, but also be bearish for most of the equity market. This would be a kind of Western market contagion being set up again. Now, the reason why I'm saying Spain, or the example that I want to show to you, I could show you many examples, but this is the main one. Spanish IBEX, giant top, question mark. Spanish stock market, the IBEX, this is the long-term chart over 20 years, showing a very long-term giant top pattern. This might be a bit too long-term for most people here, but just keep in mind we are currently testing that trend line, which I've just drawn in there, which is holding at 7563, where the IBEX was trading just a few moments ago. Now, we need to break below that level and then into the yellow support levels that I've just highlighted there. But we could potentially see a move down in the IBEX into the 6,000 psychological level over the next few months, so through the spring and summer months. And this will definitely add to more contagion within Europe. The rotation of risk will shift from Greece to Spain, but then any kind of contagion in Europe will also shift to the United States and various other markets which are exposed to the West or the rest, as it were. When the markets fall, everything becomes highly correlated. So just keep in mind, Spain is also a reason why we might see some increased volatility over the next few months. And if you look at the Spanish IBEX, ask yourself the question, is this a giant top that is about to be triggered on the downside? And what does this mean for your trade? I'm looking at stock markets, but of course you can tie this in with a lot of currencies in terms of, currencies which are good for risk trades or not, and also the commodity markets like gold, which has acted as a risk market recently. Okay, so that's the Spanish IBEX, potential tail risk over the next few months, more volatility to come. Now I want to focus on the Japanese yen in terms of trades, but also in terms of this flight to safety question mark, which a lot of people have been asking me recently. Dollar yen key levels and signals. So very quickly, after many interventions by the Bank of Japan, the market finally reversed by itself without the help of the Bank of Japan. The Bank of Japan intervened several times to try and fight the appreciation of the Japanese yen, which reached record levels last year and was hurting a lot of the export industry within Japan, which has always been very competitive. And this major cycle reversal triggered a 10% rise in just 7 weeks. And this is something that we published a report on MIT Bank in November of last year, suggesting that we were going to get this move actually earlier than that. But in the end, we did get the first stage of the move. But of course, the market rose too quickly, too soon. And so we had various overbought signals just as we were approaching the 84 mark in dollar yen. And then we had another DeMark exhaustion signal appear, that red 13 here that you can see on the chart. Remember, the DeMark exhaustion signals that I'm looking at are based on Tom DeMark's sequential indicator. And it basically looks for price momentum exhaustion. So when is the market tired and about to reverse? So that's all we're talking about here. And the number 13 signals a potential reversal in the market. I'll be talking more about DeMark indicators right at the end, because we're actually going to be holding a webinar on it next month in May. So just stay tuned for that DeMark webinar next month. Stay tuned for that. Now, what is going to happen to dollar yen now? I think that dollar yen is going to extend its pullback into the 80 psychological area. I wanted to throw an intraday chart here to say that the 80 area is one level, one key area, but we could also get a little bit of slip on the beneath that into 79.10 area. And I'm using Fibonacci levels here. That would be a 61.8% Fibonacci retracement of this major rise that we've seen since January. Now, the upside trigger level, which you need to keep in mind on the medium-term upside trigger level, is 85.50. Dollar yen must break above 85.50 for it to really kind of extend or reactivate this long-term major cycle reversal. That's what I have to say about dollar yen on the short term. Dollar yen on the medium term to long term, keep in mind that we have just surged out of this major breakout pattern, or this wedge-shaped pattern. You can see here it's roughly 4 or 5 years old, and we're just seeing a healthy pullback from that breakout, but we are more than likely to see dollar yen actually move much higher. Once we get a confirmation above 85.50, the target level, which I have said in my reports and also on media interviews, is 94. So there's a lot more upside potential here. Interesting if you also look at the options market, that also confirms what I'm saying, where there's a lot more people in the market, or a lot more potential to see further call options in the market for upside potential on dollar yen. So medium to long term, we can see 94 on dollar yen. One thing I haven't shown here on the chart is the Japanese stock market. Japanese stock market rose roughly 25% in the first quarter of this year. 25%. Tell me any market that has moved that quickly, that fast, by that much this year. And this is very much a positive surprise to a lot of people out there that are very bearish on Japan, of course, given its tragic earthquake situation from last year and the economic impact of the natural disaster of the earthquakes, and of course, various other kind of macroeconomic issues. But one thing to keep in mind, Japan recorded its first time in a long time trade deficit. And this is a country which prides itself in being a kind of competitive export-driven led country, has for the first time in many years signaled a trade deficit. And this could maybe spell a big change in the Japanese economy over the next few years. So this is a very long-term point that I'm making here. And this is why I put this trade-weighted index of the Japanese yen. So this is showing you that in broad terms, the Japanese yen has weakened. So when this chart moves down, it is Japanese yen weakness. When it moves up, it's Japanese yen strength. And it broke a few weeks ago a 5-year uptrend. So this is a 5-year uptrend breakdown, which we've now moved above. But I still think that we're going to see further broad Japanese yen weakness. Now, one of the things I want to keep in mind here is because it's a major cycle reversal in the Japanese yen, a 40-year cycle reversal in the dollar yen specifically, but also the broad Japanese yen, so Japanese yen weakness across all the currencies. What that suggests is a massive change in psychology, investor and trader psychology, in terms of how they trade the Japanese yen. And what that means is, in traditional terms, the safe haven trade may actually decrease with the Japanese yen. The Japanese yen may not be seen by investors and traders as a safe haven over the next few months and certainly over the next few years. Also, the popular carry trade will most likely diminish. So the Japanese yen over time will start to lose its status as a safe haven currency, in my opinion, and investors and traders will slowly but surely use the Japanese yen less as a popular carry trade, so i.e. borrow from the Japanese yen, the low interest rate yielding currency and then invest into high yielding currencies such as the Australian dollar or New Zealand and so on. Now I'm being asked a few questions here I want to make sure I answer. Dependent on oil imports and terms of reactors. So just GAM's making a point about the natural disaster in Japan and how that affects the country. Also asking the question, how does long-term view of dollar yen relate to the treasury market? Treasury market one is a tough one to call at the moment, but I think at the moment we see rates continue to be low, and we are likely to see a massive deleveraging over the next few months in this second quarter of the year, which may spell deflation. So I think rates remain at their historic lows for the moment, and then inflationary risks kick in later on down the line, but maybe not just now. Getting a question from Kiwi Kid. Does Japan also have debt problem, and why isn't it being talked about? Ron, instead of using intervention to weaken the currency, why don't they lower interest rates instead? These are all good questions. I think at the end, we're going to see a lot of big change in Japan. And a lot of the time when you get these long-term cyclical changes in these markets, these 20-year cyclical changes in the market, these generational moves, it is at the worst times in history for that country or for that economy. So at the moment in time, Japan might not look bullish, but in price terms, dollar yen rose 10% in just 7 weeks. The Japanese stock market moved 25% in just a few weeks. 25%. So whatever your economic perspective is telling you, from just a pure profit perspective, you would have made money if you invested in Japan. Now, I'm not saying that it's a risky trade, and I'm not saying that it's not a highly volatile trade to make. But over the medium to long term, I believe that the cycle is suggesting a major turn in Japan. It is going to be a volatile period, and Japan is generally known for that, especially if you're trading with Japanese yen. But just keep in mind, it's good to hedge yourself for these market moves. I've always recommended using options, especially on markets like dollar yen, where the directional trade can be a little bit more volatile and you get stopped out far too soon. Okay, so just a quick point about Japanese yen weakness, broad Japanese yen weakness, and that's what this trade weighted index suggests. This breakdown from a 5-year uptrend, which we've now retraced, but I think we're still going to resume that, suggesting a big change in mass psychology and capital flows into the Japanese yen. So the way that investors and traders see and trade the Japanese yen is going to change, and that is very much what is symbolized by a major cycle reversal. So keep in mind, this is what it means. This is what a cycle reversal means. It actually does change the way that we see and trade a particular market. Now, the long-term cycle that I've been talking about for so long is this chart, and I can send you the full report. Just send me an email and I can send you the full report that I published some time ago, which includes this chart. And this is a chart of the dollar yen history going back to the 1970s. I put a kind of a Elliott wave overlay there, and you can see that right at the bottom is the fifth and final impulsive wave on the dollar yen, where we have seen the reversal from. This chart is out of date, but obviously we're trading much higher now. But this is the long-term cycle reversal, which also has a time fractal in between, 16.5 year fractal, dividing up the cycle into two. Now, last bit in the last few minutes is flight to safety, and what does it mean? Flight to safety basically means, in my opinion, a move back into the US dollar. Flight to safety back into the US dollar. The US dollar is still seen as the stable reserve currency of the world. Of course, the US does and has had a lot of economic issues, but the US dollar is still holding its own. And keep in mind that we've had a very kind of positive appreciation in the US dollar already. But as we see more flight to safety, we're likely to see further gains in the US dollar. Now, the reason why I think we're going to see further gains in the US dollar is down to this picture here. All of you will know that I love pictures. A picture speaks 1,000 words. And this picture here is of the domino effect. So for some of you domino players out there, what happens when you knock one domino onto another domino onto another domino, you get this kind of a chain reaction, this contagion effect, if you will. And this is what we've seen in the popular safe haven trade. There's been a safe haven domino effect. Now, the most popular safe haven investment has been gold. We've since seen a 20% setback in gold. I believe that gold in the short term falls below $1,600 into 1522. A weekly confirmation beneath 1522 suggests further setbacks into 1460 and 1300. This means further deleveraging on gold. It still remains a bullish market, but we might get technical unwinding on gold still, which would offer a buying opportunity in the summer of this year. But my message is gold has burnt a lot of people over the last few weeks and months. Keep in mind that in late February we had a $103 drop in just one day on gold, suggesting that we might see further downside risk. So gold has kind of, just for the moment, been put on ice as a safe haven trade. Swiss franc, ever since the Swiss National Bank intervened very aggressively last year with unprecedented amounts of central bank money, basically told the market, please do not use our currency as a safe haven play and push it to record highs, because this is hurting our economy. So, a lot has changed since the Swiss National Bank really intervened. Japan, Bank of Japan hasn't really intervened as aggressively as the Swiss central banks have, but we've had a major reversal already take place in the Japanese yen, and I believe that suggests a big change in investor trader psychology and the change in capital flows, how the Japanese yen is traded. So for that reason, I question whether the Japanese yen will really see a big influence from safe haven trades. Of course, it will be affected by, over the multi-day period, maybe multi-week, but I really think that trade, that safe haven trade and popular carry trade is going to start to unwind and decrease with the Japanese yen as the natural market cycle weakens Japanese yen over the coming weeks and months. So keep in mind, it's a boxing match between cyclical forces in the market forcing the Japanese yen to weaken versus all the traditional kind of reasons that we've been trading the Japanese yen. These reasons may be yesterday's reasons and reasons that may change in the future. You have to be looking out into the future. Question from Fernando. Do you think Swiss National Bank will defend 120 like before? I think they will do their best from a credibility perspective, but the question is, will they be able to defend it against the force of the en masse market, especially if there's a risk-off environment and people then start to pile into the Swiss franc for safe haven reasons. Remember, the world is running out of safe havens. As Gan just said, they're running out of safe havens. And so that's my point here with this domino chart. Gold, Swiss franc, Japanese yen, certainly treasuries as well. Where do you put your money? If you want to, just hide your cash just for, the time ahead, where do you put it? And so, one of the last places to put your money at the moment, whether you like it or not, is the US dollar, being the reserve currency, but also being the currency which is actually looking quite positive technically. Question I'm getting here from Greg. Which currencies do you see appreciating most versus Japanese yen other than dollar? Thank you very much for asking that question. I wanted to include a slide on that, but I didn't have time to include it. Emerging market currencies, I think, will appreciate the most against Japanese yen. And I say that because it's an exact kind of polarization of what we've seen over the last few years, where Japanese yen has gained in value against emerging markets and high-yielding currencies like Canada, Australia, New Zealand. I think that we get a big change, polarization of those trades. High-yielding currencies will appreciate the most against Japan. Even if the yields on those high-yielding currencies change, they still remain significantly high, and so any changes will be minimal. And relative to the Japanese yen, these trends have big mean reversion potential against the Japanese yen. So in answer to your question, Sam and Greg, high-yielding currencies will appreciate the most against the Japanese yen. And keep in mind that's because they underperformed the most against the Japanese yen. Japanese yen gained a lot against these currencies. So just from a pure mean reversion perspective, that will change as this cycle continues. What backs the yen considered a safe haven? Why has it been a safe haven based upon export strength? I'll get back to that question. So my point here is, because of this, you're likely to see a double positive effect on dollar yen. So dollar yen potentially US dollar positive because of a flight to safety, and maybe in time, not immediately, in time, Japanese yen will be used less as a safe haven, and the cyclical market forces will continue to weaken the Japanese yen, and so you get this double positive effect of US dollar positive, Japanese yen positive. US dollar positive because of the safe haven, flight to safety play, and Japanese yen negative, weakening because of the cyclical forces in the market. And this is where my role as a technical analyst, as a market observer, is very important, in that I'm just telling you what the chart's suggesting. And a lot of the time, when you're looking at future, signals in the market which tell you something about the future, it usually means that past expectations may change, or past habits may change. So dollar yen likely to be a double positive with US dollar strength because of the safe haven flight to safety influence, and Japanese yen weakness in time, not immediately, but in time, as the cyclical forces continue to weaken the Japanese yen, and people use it less as a safe haven play and as a popular carry trade. Okay, now part 3 was the flight to safety. We spoke about the domino effect, gold, Swiss franc, Japanese yen. The world is running out of safe places to invest your money, or just to keep it. And so that is likely to be positive for the US dollar, certainly over the last few weeks. Boki's making a good point. US dollar has safe over the long term with its twin deficit. I absolutely agree with you. But for now, the amount of assets, think of it this way, forget the economic stability of the US, just purely by the number of world assets which are priced in US dollars. The US dollar is too important at this moment in time, and will continue to, for the near-term future, act as a reserve currency of the world. So I do agree with you, but just think of it also in terms of how many assets around there in the market. Think of the commodity market complex, all priced in US dollars. So, there are minimal changes to that. Some central banks are diversifying away from US dollars into euros and gold. Some assets are now priced in other currencies. But, how much of a difference is it? We're talking about trillions of US dollars priced in the popular assets. And psychologically, investors and traders are still, at this moment in time, seeing the US dollar as a good safe haven play. And one of the reasons why they are seeing that is because of this domino effect. So that's the third reason, I would say, because popular traditional safe haven plays like gold, Swiss franc, and now Japanese yen are, step by step creating this domino effect where the world is running out of safe places to invest one's money. And so the US dollar is now being magnified as a good safe haven play. So I agree with you. Economically and long-term technically, US dollar is bearish, but at least for the coming months, it's likely to be positive. I do see the US dollar changing its trend in the summer of this year. That's a key cyclical zone for me, where you might see US dollar weakening and gold actually gaining in value. So summer this year is a very important point for the risk trade, but also for US dollar on the downside and gold on the upside. Just please keep that in mind. Question is, US dollar printing makes less value. This printing press point is important, but it's more of a macro, very, very long-term perspective. And whether it affects the market or not in the short term, I would always say whatever headlines or whatever beliefs you have, economic or politically related, keep in mind what is the chart telling you, and what is the US dollar chart, index chart telling you. The market's already almost up by 20 or so is likely to continue up to 30%. That's in my call from last year. So whether the US dollar is having an economic crisis or not, whether it's printing lots of money and making its currency more worthless, if you're a trader and you're an investor, you would have made money by buying the US dollar. And that's what really matters. Now, from a pure discussion perspective, I agree with Boyke's perspective about currencies across the world, especially in the West and especially in the US, losing value because, the governments are just printing more money, they're creating inflation in the system, and money's becoming worthless. That's why commodities are gaining value because you have hard assets outperforming fiat assets. But from a pure chart perspective, the US dollar has been positive, almost 20% or more on the US dollar index, and is likely over the next few weeks and months into the summer of this year, up until the summer of this year, likely to appreciate in value. And there are many reasons for that. Number one reason, technically, it's still positive. Like I said, it's 20% or more up. Number two, it is still the reserve currency of the world, and just purely from the number of assets out there in the market, which are priced in US dollars, that will keep the US dollar as a very important reserve currency. And number three, this domino effect, which I've been talking about, when we've had traditional markets like gold, Swiss franc, and Japanese yen, all getting hit one by one, and magnifying the flows, capital flows back to the US dollar. So, like it or not, US dollar has gained in value and is likely to gain further in value, but I see an important kind of resistance area in both price and time terms in the summer of this year. So I do see limited upside US dollar strength into the summer of this year, where we might get a change in big markets like the US dollar, gold, stock markets, and so on. Stay tuned for future webinars, and I'll talk more about that. So that's my final slide on euro dollar. I didn't want to show you the US dollar index, but I want to show you a market you can trade and know. Euro dollar is, as we speak, also showing a reversal pattern over the last few months. I don't like calling patterns names. I just like to keep it very kind of general. And we can see here a reversal pattern beneath the 200-day moving average, needs to confirm beneath the psychological 130 area. And once it does, I do expect a measured move into the early lows of this year at January, which is roughly around 126 and a bit. Euro dollar is likely to target 126 and a bit, and that will be part of this risk-off period that we have started, but also because of this, domino effect into US dollar that I've been talking about. Now, I'm going to take questions at this moment because I think I'm over by a few moments, and I'd like to finish in time. My mantra for each of these discussions is enlightenment, realized knowledge. It's a really important belief of mine that we should share ideas and share questions. We learn from each other. And just a quick point that if you have any questions or are interested in any of the charts or any of the reports that I write, please just email me at r.william@migbank.com. I can maybe also set you up for a 1-month free trial. Our marketing team have kindly agreed to that. You can also catch comments on MIG Bank Facebook, or from me personally on a real-time basis, Twitter, rwilliam77, and LinkedIn, Ron William. Feel free to reach out to me and be a contact. And also various blog updates that I will start to put on forexstreet.net. They're a fantastic blog site. Now, the last thing I want to end on is the next webinar. You'll be happy to know that as we approach this fantastic summer period, I've been really looking forward to the summer here in Switzerland. I like to sail on the lakes of Switzerland, so I'm looking forward to spring and summer. I have suggested to FX Street that I would like to organize an educational series of seminars. I've covered a lot of market outlook webinars, so over the next few months I will keep it educationally based. And the next webinar will be market timing using Tom DeMark sequential indicators. So whenever you've been hearing me talk about DeMark indicators, I can now explain them to you. Tom DeMark, a modern market wizard. Market timing is everything, especially during volatile markets. What are the key stages? TD setup, TD countdown, how to successfully trade 9 and 13 buy and sell signals, managing your risk profile using TD Risk, and practical examples and current market signals. That webinar, exclusive webinar on Tom DeMark's sequential indicator, is scheduled for the 7th of May at 3 p.m. GMT. So please come in for that. And just one quick highlight, I think FX Street already mentioned, I will be at the FX Street annual ITC event in Barcelona. Really welcome all of you. I wish all of you could fly out there and so that I could meet you and we could kind of have long discussions about the market. But no, on a serious note, if you can be there, it would be an honor and a pleasure to meet with you. FX Street has given me discounts for some of the committed attendees here that would like to attend. So just send me an email and I can send you details about how you can get discount entrance into the FX Street ITC event. And if you want any more details about that, I think FX Street team can, I think they already have put it in there, June 2012, Barcelona, Spain. Spain's a beautiful country. Barcelona is even more beautiful. I look forward to seeing you there. Enlightenment to realize knowledge, and please, please, please sign up for the next webinar, Market Timing, using Tom DeMark's Sequential Indicator, 7th of May, 3 p.m. GMT. Thank you very much. An honor and a pleasure to be sharing this time with you. Have a great, great, great spring. See you next. Bye-bye.